Lights, camera, action. And we're live. What's going on, everybody? Welcome to Wolf. Happy Monday afternoon. We coming at you for two streams today, actually. We converted the Market Talk space into a stream, and we have our part two. We're going macro. We're diving deep into the markets today. We have Robert here, Infonomics, fellow YouTuber, fellow X creator, fellow Spaces guy, lover of all things nerdy, macro, Bitcoin, all those things. So, Robert, thanks so much for coming on, man.
Yeah, good to be here. Definitely a nerd. That's the most accurate description of me, I'd say.
Same with me, dude. And we
Mega
found a
nerd.
home where people are happy about it. And
Yeah.
they want to talk at length all the time about all the things going on. And I know there's a ton of things happening in the world. Obviously, this is kind of our segment where we get to dive a bit deeper into your brain and see what things you're paying attention to. You've been able to make some pretty interesting calls over the last few months and years, just because you have a unique take on the market. And so a lot of people have followed you. You've got a huge following on YouTube and X. So for some reason, people like the things you're sharing. So I'd love to see what kind of things you're seeing the last couple of days that you've been paying attention to.
Yeah. So this we'll start with this post from Endgame Macro. He's really smart guy. Seems very similar minded to my sort of brain. So I appreciate that sometimes when I can pick up on that from people. Really smart guy. He's referencing this post by Santiago Capital, who's Brent Johnson, Dollar
Oh,
Milkshake
did you want
guy.
to shrink this window, by the way, Robert? At all? It's still like wide on this one, so I think it's like the thing you were talking about. I don't know if it applies on this one.
Weird.
Yeah, because it's super wide right now.
How did I do that before? I had it like
you shrunk the window itself. Did you do that already?
There was like reader mode that I had put on. There we go.
There it is. Nice.
There we go. Okay. I guess I can't click on his post. That's fine.
Gotcha.
Okay.
No worries. Oh, I see what you're doing now. I see.
Yeah.
Got it. Okay, though you may not be able to then on this one. Here, let me see. I can actually, if you want to send me the link, I can actually pull that one up as well. I can see if the window would be smaller if you want. Otherwise, we could just pull that one up too.
We can. No, I know what he was talking about.
Okay,
so
cool.
I can summarize it. If
Nice.
you want to start over, cut it.
No, it's all good. Yeah, we'll cut it in post, but we're live now, so we can just move on.
Okay.
It's all good.
So what's going on here? He's talking about a post by Santiago Capital, who's of course a very large dollar bull. And what he's referring to is a concept of global collateral. So for the reason that the U.S. Treasury, the reason people talk about the dollar as reserve currency, what they're really talking about is the U.S. Treasury as a global reserve asset. And historically, it was used that way. It was safe. It held its value. Generally speaking, we were in a 50, 60-year bond bull market. So the value of the bond itself was rising as interest rates were falling. And historically, it was a very good store value for a sovereign like a oil exporter, right? If the US is buying oil from some Middle Eastern country or something like that, we are sending them more money for their stuff than they are buying of our stuff. So they needed some way to store that. Well, the US Treasury was historically the best way to do that. But what we've been increasingly seeing over the past couple, arguably going back a decade, is a reduction of the dollar or the US Treasury as that kind of global reserve asset, that store value. And especially over the past couple of years, and I would say especially over the past couple months or year or two, we've seen a dramatic spike in central bank buying of gold. And it serves basically all the same purposes, which is, if you're China or Japan or Saudi Arabia and you run a current account trade surplus, you need a way for your people, imagine you're running a hedge fund, but it's for an entire country. It's for an entire populace. You need to make sure that you're able to, what you are saving that wealth, that capital, you need to make sure that it's a safe store value. And number one, and number two, that no one can take it. So what we saw in 2022 was the US Treasury was basically, we start seizing US Treasuries that Russia owned. And gold doesn't have that issue. But not only is there kind of an issue with the US Treasury, the dollar because the US Treasury is basically an interest-bearing dollar. That's really all it is. You can think of a US Treasury relatively equivalent to a dollar. It's just an interest-bearing dollar. But like if you're in Saudi Arabia and you own a US Treasury, you are long the dollar, kind of by default. So you can think of US Treasury as a dollar, an interest-bearing dollar with a maturation. And what he's referring to is this phenomenon where not only did we did US Treasuries kind of stop being a good store of value. We know they're, especially during 22, 23, 24, long-term treasuries were down like 40%. They had lost like half of their value. So not only that, but now he's kind of getting into the collateral side of it, which is the collateral for the entire financial system has been the US Treasury. So kind of a separate but related sort of concept is the collateral with which the financial system uses, and that's historically been the US Treasury. Well, what we've seen in the repo markets recently have indicated that the kind of plumbing of the financial system is starting to clog up, or it's starting to crack. It's starting to freeze up. There are certainly some issues with kind of that plumbing of the modern day financial system. We can see that in repo markets, which is what this is looking at. And so he presents kind of an interesting take, which like I hadn't even really considered. I've been covering the SOFR spread for, I don't know, a year maybe. And I had never really stopped to consider that part of the reason that we are seeing this dramatic spike in gold is due to the fact that like the plumbing of the financial system is cracking. I kind of attributed, well, they're worried about the debt. They're worried about that interest is 23% of tax revenue. They're worried about like, the fiscal deficit. They're worried about those kinds of things. I had never stopped to consider they might be worried about the actual plumbing of the kind of old financial system. And so that is what this post is referring to. And so I decided to test it and pull up one of the charts I had from the video I did yesterday. And sure enough, there's like a very, very strong correlation here. We can see that.
Are you able to show it? I have the tweet page pulled up here, but let me jump to that screen.
I'll pull up this. So this is better.
And by the way, for people who are watching, if you haven't already, please retweet the stream. And by the way, Robert, I put the link in the private chat. But
Okay, cool.
if you haven't already, please do retweet the stream. Follow on X. If you're on YouTube, hit the subscribe button. And Robert's, all his information is, if you're on YouTube at least, it's in the description. And if you are on X, you just click his handle right above our faces. So just click infra, and it will take you there. You go to his link tree. You can find his YouTube from there. Highly recommend it. And give him a follow on X too. He's posting a ton, obviously. So, all right, back over to you, Robert. I see I got your chart pulled up.
Yeah. So this, I already had this chart, the SOFR reverse repo. What we're looking at here is SOFR minus the reverse repo award rate. And here is probably like the easiest way to think about this. So the way that the Fed, you've heard all this talk about the federal funds rate. Well, it's actually not the federal funds rate. It is actually a window or a corridor or range. And so this is that range. The way that they set the federal funds rate is by using multiple different interest rates. So we see here in red, this is the reverse repo award rate. I'll try to pull up the labels here. The red is the reverse repo award rate. And basically what the Fed is doing here is they're saying no matter how abundant dollars get, we will always pay you a minimum of 4%. Right now it's 4%. And what the top, the discount window rate, this is basically saying no matter how no matter how scarce dollars get in the system, in the plumbing of the financial system, we will always provide them to you at 4.25%. So by doing that, and of course, there's also interest on reserve balances, which is part of how they effectively set the federal funds rate. But what they're effectively doing here is they're setting a floor in the price of $1 and the ceiling in the price of $1. And then in yellow, what we're looking at is what's called SOFR. This stands for Secured Overnight Funding Rate. And this is basically kind of a free market derived interest rate that is based on supply and demand of dollars. So the Fed would like the interest rate, the overnight interest rate. That is, most normal people don't have access to these markets, but if you're a hedge fund, a bank, a money market fund, this is where everything happens, these overnight dollar markets. That is, of course, what the federal funds rate is. It's an overnight interest rate. Well, this is the way that they set that interest rate. What SOFR is kind of, a much more free market interest rate than what the Fed by decree. As you can see, the discount window rate, just stays the same. The reverse repo award rate, that just stays the same. When the Fed makes a rate decision, all of those kind of shift downward, kind of in unison, and then they just stay there until the Fed hikes or cuts. So these are kind of like once you start to see SOFR, which is again much more of like supply and demand. I mean, imagine you are the only guy on Wall Street that has 100 billion bucks, and everyone is trying to pay taxes. They're trying to make sure that their balance sheets look good to regulators and investors. There's so much financing that goes on in these markets. There's $3 trillion about financed in these markets every night on an overnight basis. If you're the only guy on Wall Street that's got $100 billion and everyone else needs to pay taxes, they need to make sure that they, pad their balance sheet with a bunch of cash so they don't fall into, issues with the regulator. Well, you get to charge a very, very high interest rate. Your price gets to be much higher than what would be indicated by these kind of Fed interest rates. That is what we're looking at. The difference between what the free market is saying the supply and demand of dollars is relative to what the Fed will kind of like that to be. And as we can see, there's a lot of kind of fluctuation with SOFR. And of course, around quarter end, we can always see that it spikes. These vertical lines represent quarter end. And so this is a major point in time for the banks, for financial firms. This is, of course, quarterly window dressing. And then, of course, also month end. So here in purple, these are month end. And so what you can see, hopefully, is that generally SOFR will spike and kind of blow out above the federal. You can pick different interest rates. Really, it's the same thing. As you can see. You can pick SOFR over the federal funds rate. You could do SOFR over IORB. You could do SOFR over reverse repo. It's all kind of illustrating the same thing, which is what is the magnitude of dollar scarcity relative to what the Fed would like it to be. That's really all. You could pick any of those. That is all it's telling you. So here in the lower pane, we're looking at SOFR relative to the federal funds rate. And again, SOFR is telling you in the real world, are dollars scarce or are they abundant? And then the federal funds rate, again, is what the Fed would like dollar liquidity conditions to be. So the difference between those two, you can see that during quarter end and month end, SOFR will blow out. The cost of money, the price of a dollar will start to radically increase above and beyond what the Fed would like it to be, but then it returns to kind of a historical average. So that is what we're really talking about with SOFR or SOFR spreads. Here in white, what we're looking at is a moving average of one of the ways of looking at SOFR, which is taking the yellow line here, which is SOFR, and subtracting out the reverse repo award rate, which again, this is the Fed trying to guarantee no matter how overabundant dollars get, we will always pay you 4%. So they are trying to set a floor in the price of a dollar. And just for kind of comparison's sake, when dollar liquidity was overabundant, you actually saw the reverse happen. Like here, we're looking in 2022, SOFR was actually dipping below the floor. So here, for example, in June of 2022, we can see that SOFR was at 0.69 and reverse repo award rate was at 0.81. Well, that represents 13 basis point difference. SOFR, there were so many dollars that had been created during this period of time. Everyone had dollars. No one really needed them. And so therefore, the actual price of a dollar, the actual cost of a dollar or a dollar loan, the actual interest rate was below what the Fed wanted it to be. So it goes both directions. You can have conditions where dollar liquidity is super, super tight, which is where you see SOFR spike to the, above the interest rates, or you can have it the other way, which is where dollar liquidity is so abundant that SOFR is actually lower than the Fed would like. And so again, the reverse repo award rate, this is the floor that the Fed is trying to set in the price of a dollar. That is what we're looking at, the difference between those two. And we took a 14-day moving average. What you can see is that the breakout in gold, which by the way, 2000 here, gold had tested 2000 or 2050, tested it here in August of 2020, then it tested it again in March of 2022. Then it tested it actually like 2 or 3 more times. And so this breakout here was really kind of the massive start of this leg higher. That was February 2024. And if you look at when SOFR minus reverse repo, again, telling you the degree to which dollar liquidity is scarce versus what the Fed would like dollar liquidity conditions to be, you can see that it coincides with the breakout in gold. And so, yeah, I thought it was a good point. It probably is hard to find data on, like, out of all the gold purchases, how many people are buying gold because they're worried about the plumbing of the financial system. Obviously, hopefully it's clear that this 2-week moving average has been moving up and to the right. And by the way, recently we've kind of started to like blow out on the spread. We can see it went from 10 basis points to 15 basis points. And sure enough, if we put gold back on, that is exactly when gold has started its kind of dramatic run higher. And so, yeah, it was an interesting correlation. Maybe not causal, 1-to-1. There's a number of reasons to purchase gold, but it's kind of one of many contributing factors that does make sense, because gold, if you're worried about U.S. Treasuries and the repo market and counterparty risk and those sorts of things, well, gold has no counterparty risk, and is kind of the 5,000-year-old collateral. It is kind of the oldest money that exists. So if you're worried about kind of all of those different areas of the old system, whether it be U.S. Treasuries not holding their value, whether it be, oh, well, the U.S. might seize my treasuries or default on them, all these sorts of things, fiscal deficits, right? All those sorts of issues. You add in that, the kind of plumbing of the financial system is starting to freeze up. And it does make sense that gold would get some bid, right? Like maybe 10% of what's happening in gold is due to what's happening in the repo market. But yeah, you can see that like the purple line or the pink line here, that is 0%. So what that indicates is that SOFR and the reverse repo are basically the same interest rate. And as this white line is moving higher, it's indicating that SOFR is kind of trending above what the Fed would like the floor of the cost of money to be.
Oh, I see. Dude,
So
how
this is
does
the
someone even get
degree.
into this? How do you even get to the point where you're like, I should be paying attention to this? Because that you just laid out an excellent argument for why you should be, but I was like, I didn't even know this was like a thing.
Yeah, so most people think the Fed sets one interest rate and
Yeah.
they just do it by decree. This is how they actually make that interest rate what they want it to be. They
Wow,
use
this is
the discount
insane.
window rate, yeah, the reverse repo, and to some degree IORB and Fed funds a factor in there. But of course, during 2019, there was this. So during 2019, the Fed was engaged in quantitative tightening, and very similar to how they are now. And as you can see, they were hiking interest rates here during 2018. They were hiking interest rates. They were engaged in quantitative tightening. It was Jerome Powell, too, another kind of parallel. And so liquidity conditions were getting tighter. I think SOFR was introduced here in 2018. I think that was when you make the switch from LIBOR into SOFR. So that starts here. We can see they're hiking, they're reducing their balance sheet, which has a negative effect on dollar liquidity. And sure enough, here in September of 2019, it was actually even worse than this on an intraday basis. SOFR spiked on an intraday basis 900 basis points above the federal funds rate. So this was the repo rate crisis that people talk about. And what started it was reading about this particular crisis where, yeah, it was actually even worse. It spiked like up here.
How
Yeah.
what does that look like? Like, what does it even mean? Like, how
So basically, dollars didn't exist on Wall Street. Like that analogy that I gave in the
yeah.
kind of in the beginning, you're the only guy on Wall Street with any cash,
Wow.
any actual cash. Everyone had
Wow.
treasuries. The
Yeah.
issue,
Okay.
so in this repo market, what you're doing, one person has treasuries, one person has cash.
Cash.
You might
I
say,
see.
I got 100 billion of these US treasuries, but I need cash. I need actual dollars. And I might have actual dollars and be willing to swap with you overnight. And of course, you pay an interest rate, which is the SOFR. The SOFR interest rate, that is the cost of doing that overnight swap.
I see.
But yeah, what happened during this period of time was they tightened liquidity so much through both, hiking rates, but also quantitative tightening. They had reduced dollar liquidity so much that it wasn't really an exaggeration. Like there was probably like one guy on one firm
Just
on
running
Wall
around
Street,
with all the cash.
yeah, that had the only cash
It's
in the entire
insane.
thing. And so that guy
What?
got to charge 9% higher than what the Fed wanted it to be.
Wow. That
And
is gonna be
also,
the craziest thing I've ever heard.
yeah, so this would have arguably been worse than 2008 if it had been allowed to continue. Now, of course, what the Fed did in response, they pretty much immediately started QE. They increased balance sheet.
Got it.
Here we can see they start increasing their balance sheet, and then of course we know what happened here in 2020.
Mhm.
Couple months later, just so happened to have something come about which necessitated a printing of a lot of money. It's a coincidence, of course,
Of course.
no,
Always a coincidence.
nothing there. But yeah, this was September 2019, and what was going on? Part of why that date is significant is tax deadline. So
Mm.
some are kind of discounting the SOFR move, right, as well. September 15th, that's tax deadline. And so, yeah, you get a spike. And sure enough, we did. It actually went above the ceiling interest rate, the Fed ceiling interest rate. That's how high. You can see that very rarely happens. One time, two times, three times. And this chart goes back to like early 2024. It's only happened three times where the actual SOFR interest rate goes above the ceiling. So the price of money is higher than what the Fed would like it to be. It's only happened three times. And generally, as you can see, it was either quarter end or month end. Well, this time it happened, it was
Wow.
neither of those. It wasn't quarter end and it wasn't month end, where these firms need a bunch of capital and it's always kind of volatile. This time around, it was not quarter end or month end. It was tax deadline, however. And so there was a question of like, well, yeah, is this spike really that notable? Or is it just due to tax deadline? Everyone needs cash to pay tax. And so, then it'll calm right back down. Well, it hasn't really calmed right back down.
Mm.
And so the
Right.
trend here is kind of clear, which is that SOFR has been, and that's why I use the moving average here, is because there is a lot of volatility kind of day to day. It helps kind of give you an accurate picture of what's really going on. And as we can see, for 2025, there's a very clear trend up here in the SOFR minus reverse repo. So the moving average can kind of help sift through the noise. And, as we can see here, even as of the most recent data, it's still elevated. Like SOFR is still elevated, indicating the Fed, well, maybe not the Fed, indicating that dollar liquidity is still tight, right? So it's one thing to say, well, yeah, but it was tax deadline. Everyone needed cash. So yeah, SOFR is going to spike, but we're still 7 basis points above the federal funds rate. This is above kind of the average. So we have quarter end tomorrow.
Yep.
So yeah, I would say it's definitely something to keep an eye on. The end result of this, if you go back to 2019, is the same thing, which is the Fed just prints money.
Yeah.
Because what this is reflecting is a shortage of cash, a shortage of dollars.
Yeah.
When SOFR does this kind of thing. So yeah, the Fed prints money.
But this time, like that's basically what I've heard so many people talk about. It's like basically the only conversation happening left in Bitcoin, where we are so far into this 4-year cycle that everyone's like, look, we got like quite literally, I don't know, 50 days max to figure it out if it's going to happen or not. And everyone's like, okay, we're about to get potentially a full money printer mode, but we're at the end of a 4-year cycle. We should be heading trending down. And so there's all this conversation. Some of the top macro people I've seen, like Jeff Park, nobody has expressed any fear of a 4-year cycle downtrend for the next year. Like nobody, except for the traders. Now, my traders have been scary on points though, week to week, like scary on points. Like they're like, hey, I think we're gonna hit a 108, we'll probably come back to 105, then 110. Like they're seriously good. But they're the ones that are typically calling. They're like, look, everything makes sense and everything is lining up too well for a 4-year cycle to play out exactly like it's always played out. So I want to get some of your thoughts on, with all these moving parts, where are you at with all this?
Yeah, I don't see that. I've lived through a number of cycles. I've been in Bitcoin a while, in and out, like not like a hardcore OG
Sure.
or anything, in and out. But I've seen the cycles, and that's kind of like how I experienced Bitcoin. Was like it would run, I'd make some money, and be like, oh well, 200%, I should sell. And then I would like forget about it for a couple of years, and I hear about it again, and then buy it again, and right. So I was in and out. So I'm very well versed in the cycle theory and the way that it used to work. I think nowadays, with it being a $2 trillion asset class that has the staggering amount of derivatives already
Yeah,
built on
a
top of
lot.
it, and kind of institutional adoption and all the various things that are going on with Bitcoin over, say, the past year or two, I think it's a different story than what it was in 2013. And yeah, like I think what I see as a trader is like a pretty picture perfect, like bull flag kind of situation, you know.
Mm.
And from a macro perspective, I think that, look, you can always get with the S&P 500, you can always get like a 5-10% pullback. That's basically like no matter what is going on, you should have as a pretty high likelihood that you're going to see a 5 to 10% pullback, in my
Sure.
opinion. And the same is true for Bitcoin. You just kind of multiply that by 2, right? So Bitcoin can always have like a 10 to 20% pullback.
Mhm.
But that being said, like I don't really see what is going to be so bearish for risk assets. Bitcoin basically just follows Nasdaq. It's we can not like that, but that's just how it is right now.
That's true.
And so yeah, like basically what you're talking about, if you're calling for a significant pullback, like a 50% bear market,
That's what people are calling for, 50 to 70. And I'm like, look, if
yeah,
that
so
happens, that's fine. I'll be happy to stack there. I'll just keep my job, but like, that's fine. And I tell everyone to get a third job if that happens, but I just don't see it happening. I'm like, why would we drop down to 40K again, or 50 or 60, 70K? Like these numbers, I'm just like, I could definitely see the 60, 70, but I've heard the calls back to 40. I'm like, dude, brother, I just don't, I mean, that'd be great, but I just don't see it happening.
yeah, I mean, you're talking about like a bear market in Nasdaq. You're talking about a bear market in the S&P 500, unless they're calling for a bear market because of something idiosyncratic with Bitcoin, like the treasury companies are going to blow up. Therefore,
Of
there will be forced liquidations,
course,
and
of course.
Bitcoin will be in a bear market, but Nasdaq won't.
Yeah.
Generally, the
True.
correlation between Bitcoin and Nasdaq is like very, very strong. So yeah, if you're calling for kind of like a massive pullback in Bitcoin, you should, in my opinion, have a reason of a macro view that's going to take risk assets, broadly speaking, lower.
Yeah.
Otherwise, maybe it's an idiosyncratic thing with Bitcoin treasury companies or something like that.
Hmm.
This is a 20 week moving average. We'll do like a 50. The correlation is pretty strong between Bitcoin generally, right? Not intra-minute, not minute to minute or, hour to hour or anything like that, but the correlation is pretty strong. So maybe there's an idiosyncratic thing that takes out Bitcoin. Maybe it's the treasury companies or something like that. I'm not in that world enough to really know like the finer details, but like when it comes to SPY and Nasdaq, like I think it probably continues to move higher. Like yeah, valuations are crazy.
Hmm.
Yeah, like the concentration of a couple companies in NASDAQ or SPY, like these market cap weighted things. All of those are true. But like, I don't think that we had GDP come in at 3.8% for Q2. Q3 is looking like 3.25. There's really no talk of like Federal Reserve rate hikes. There's like cuts, right? It's just a question of like, well, how much cuts? But we're in a cutting cycle. So yeah, I don't really see like some recession. I don't see some significant pullback in kind of risk assets, broadly speaking, NASDAQ, SPY, Bitcoin.
Are those typically caused by like the black swan that I was talking about? Because in my head, like the most obvious answer is these treasury companies, 90% of them don't know what they hold. And so they will dump that because they will be terrified of their shareholders, but there's only a handful in my head where I think the founders, either the founders get it or the founders have that hold on the community where maybe their shareholders are going to be okay with the fact that they're kind of in a negative feedback loop, or they have the potential to be in a massive negative feedback loop depending on how their business is set up and if they did a pipe or whatever. But I could definitely see a scenario where the treasuries could be our downfall here. And I don't know. I feel like that could be pretty damaging actually to Bitcoin's reputation on Wall Street, which I don't know if it's good or bad. But I could definitely see that playing out.
Yeah. I mean, I don't know. MSTR, this is the one I always check when it comes to treasury companies.
Of course. Yeah, of course.
This like
MSTR, I don't think it could happen. I really don't.
Looks pretty
I think
good, honestly. Like, this
seriously?
honestly looks pretty good to me. I don't have like a strong view one way or the other. What's another one?
For the I mean, there's a million treasury companies. I'm trying to think of one that's like similar size to. You could put Mara if you wanted to, like Marathon Holdings, like the Bitcoin miner. They hold a ton. They're probably second or third.
God,
that's,
that's crazy.
Yeah, you could throw in. I'm trying to think of the other Bitcoin treasury. You could try Metaplanet. They're a Japanese stock though, so I'm not sure how it might just be for. I'm actually kind of curious to see what their chart looks like. They're in Japan. They're a Japanese stock.
Yeah. This one?
Wow, is that Metaplanet stock?
Because TSE, I'm pretty sure is
that Japanese stock market.
Pretty sure.
If it is, it might be.
I don't think so though, because I feel like I've seen a Metaplanet chart and it was like parabolic.
I'm sure it's good. Yeah, I think it's good. I don't know if that's the right one. You could try. I mean, to be honest, like all the ones I know, the charts are terrible. Like they all look like that. Like type in similar. Type in SMLR.
I was on the monthly. So
I see.
Yeah, this looks like how I remember Metaplanet to look.
But it's corrected quite a bit.
Yeah, like I remember this part and people were like doing crazy stuff to go super long on the parabola up, and just same thing as MSTR when in November 2021 and I did spaces with you guys too, like here literally the top. I was like telling people no, they were like buying call options with an IV of like 500. They were like, oh yeah, MSTR is going to like 3,000. I'm buying these.
I remember this.
Out of the money. I was like, no, guys, like IV is like jacked to the moon. You sell options here. And if you would have sold calls there, it was literally the top that day where I think I was in like 3 spaces. I was saying it every single space, like, no, please don't. People were doing really reckless stuff. Like it was, like,
do you feel that energy now from the treasury companies?
I mean, no, going back to the Metaplanet one, like it's pulled back like a lot.
It has.
Could it pull back more? Like, of course, but yeah, I don't know. I mean, I wouldn't try to cut. That's basically a falling knife.
It is, yeah.
There's like some support here, like low 300s maybe, but yeah, I mean, I don't know what's going on with Metaplanet, but if you look at MSTR, it looks pretty good. So I don't really, I don't follow the treasury space enough to know whether a black swan is like, I don't know the leverage ratio and the capital structure of these it's all.
I mean, it would come from what DarkSide talks about. It would come from a cascading price action of Bitcoin rapid. It would come from the people who, like the companies who are holding the Bitcoin, and the whole promise has been, we will increase the valuation of everyone here because you bought our stock because we hold Bitcoin. But now Bitcoin's down, and his thought is that you'll probably sell the Bitcoin in an effort to save something for the shareholders. And because they don't know what they're holding, my fear is that they'll just start selling. But at the same time, there's been so much absorption. Like there's so much absorption as well. Like there are so many buyers of Bitcoin too. So I don't know what that looks like, but I get the sense you might be right though. Even if we had that cascade, we could see that scenario play out and only have Bitcoin drop 10 to 30% at most. I mean, we could have that full black swan and still play out nowhere near as a 70% correction.
Well, yeah, because like, look, the thing, by the way, if you bought that day in November where I was trying to scream from the rooftops, you're down versus Bitcoin, you're down 50%.
Oof.
You lost half your money. You should have just bought Bitcoin. What was I going to check? BTC. I was going to point this out. Like we are basically what an uptrend is. Not like the best looking bull flag, but that's kind of bull flag-y. What you're talking about, like on a very, very long-term time frame, being in an uptrend, you kind of have to go to log to really see it. But really going all the way back to the earliest days of 2009, what you see is every successive drawdown, you set a higher low. And so by definition, higher lows, like, you know, if we set a new low and we break below, say, 15K, then everything would probably change in my view. Like that would get me maybe rethinking some things. But like generally speaking, what happens is like there's a pullback or a bear market, right? Back in the cycle days, there's a pullback. You set a higher low, buyers come in, boom. You have a pullback, buyers come in earlier than they did here. So you have a higher low, you know, rip up, pull back, buyers come in even higher than they did at this one. That is what like an accumulative sort of price action looks like. A bullish price action is by definition, you're setting higher lows. So I think, yeah, like could Bitcoin pull back to like, I don't know, maybe back to the 70s or something in that sort of event? Maybe. It's totally possible. I don't know the structure of these various treasury companies, but I would expect that if it did pull back to the 70s, people want Bitcoin. What this is telling you, what this price action tells you, is that people are willing to come in at ever higher prices to set a new floor. That's bullish. Like from a human behavior, remember, price action is just human behavior. That tells me that like people really want this thing called Bitcoin because they're willing to come in and like buy it at ever higher prices as time goes on.
Right.
So yeah, kind of by definition, it's in this like generational uptrend. And so I would expect, yeah, like
that.
you know, 70, 80, 70, something like that. Maybe you could see a pullback. Because yeah, I just don't see like a macro force. SPY looks good, NASDAQ looks good, like the economy is fine, there's no recession. Yeah, real GDP came in at 3.8%. Like,
yeah, what do you think about that?
And I had people, a huge amount of my timeline was people talking about an imminent recession. And then you have real GDP coming at 3.8%. This is the annual rate, is reported quarterly. It's an annual rate though. 3.8% annual growth rate. Yeah, and then you look at like inflation, that's basically at 3%. Like especially if you use core, that's basically running at 3%. So you're talking about like a 6% nominal growth environment. And people were like convinced that we're going into this like depression. It's like, what?
Yeah,
It didn't really make sense. And a large part of it was payrolls. So that was really what was US. This is really what was like worrying people. But in my opinion, it's kind of dumb because, you know, yeah, we got used to having like absurdly high non-farm payrolls back here, right? 200,000, 300,000 non-farm payrolls prints. But we were also importing millions of people from the rest of the world under Biden. This administration is doing the exact opposite, which is they're sending more people back than they're letting come in. So the break-even rate, yeah, used to be 200,000, or I think somewhere around there, depending on the time period. About 200,000 was the old break-even rate where the economy had to add a lot of jobs every single month just to kind of break even. It used to be that, but like, yeah, you look at what it is today, given the policies of this administration, it's much lower. Kind of estimates are between like 10K and 50K. So yeah, like a non-farm payroll sprint of 22K, like It's fine. Yeah, it's way lower than we got used to, but yeah, but we're not, importing huge amounts of people like we were during the last administration. So your labor market is going to tighten. And if you look at like um, jolts relative to unemployment, this was another thing that people made a big deal about. So if we make it one scale here, recently you had this cross where unemployment went above job openings ever so slightly by like 600,000, I think. Very ever so slightly. You had the level of unemployed people above the number of job openings in the economy. And this was like the first time in 4 years that this happened. And it was this sign of imminent labor market cracks.
Mm.
But like you zoom out, and this is from 2001 all the way to 2018. Like here, I'll just pick a couple random points. Here, unemployed was 4.3 million above job openings. Here, let's just pick another one. Here it was about 12 million higher. Of course, that was the height of 2008. Let's pick here, 7 million, right? So like by the millions, there were higher unemployed than there were
Wow.
job openings. And from 2000 all the way through to 2018. So yeah, like what was abnormal was this part, right? Like even before
Yep.
2020, you had a pretty strong labor market, right? And job openings were above the unemployment here, but like barely. You know what I mean? We're talking like 5.8 million to 7 million. Talking like 1.5 million gap, where job openings are about 1.5 million above unemployed. That's a tight labor market, strong labor market, okay, but like not 12 million versus 6 million, right? That's a 6 million. This is the anomaly, right? The problem is everyone got used to this labor market, and this was the anomaly. And you start kind of letting some of the monetary trickle, the long and variable lags from the Fed, what the Fed did. And you also have a reversal of all the immigration policy that the last administration had. You're going to get a normalization where, yes, job openings come down,
Mhm.
unemployment goes up, but like we haven't seen the nonlinear. I'll put recessions on here, so and then go the unemployment rate so people can see. In a recession, you have the unemployment rate go nonlinear, and we're not seeing that. So yeah, I don't think the labor market is. Oops, what did I do? I
What?
don't think the
Another
labor
spec.
market is doing this
Mm.
sort of thing, this nonlinear spike which is what you see when you go into a recession. I don't think it's doing this. It's just normalizing. Now, if you start to get a spike in the unemployment rate, you are starting to see that with youth unemployment. So youth unemployment is 10%, 10.5%. So this is starting to move, and generally youth unemployment moves before overall unemployment. So you are starting to see a bit of that kind of nonlinear move higher with the youth unemployment. Also, if you go to Black unemployment, that also historically moves before the overall unemployment. That is kind of starting to go nonlinear. So the labor market's certainly weaker than it was. But in terms of kind of like this collapsing economy, you have 3.8% real GDP for Q2, which every successive revision was revised higher. Consumer spending got revised higher. Q3 is running at 3.25. Like, we have a massive fiscal impulse coming in the first quarter of 2026 from the one big beautiful bill. So that kind of like artificial juicing that the last administration did a lot of, we're getting that same dynamic in first quarter of, which is basically 2 months away.
Yeah.
It's the end of September. So yeah, like I don't really see this impetus for a bear market in risk assets, huge spike of unemployment, um, recession. Like you have GDP at like 3.25 for Q3. Like where is the negative growth shock going to come from? And also,
Mm.
you don't really have the bond market You don't really see that with the bond market. So if we look at the yield curve, there's not really like an imminent growth scare sort of price action with, say, the 10-year treasury. We're not really seeing that. So back here,
Yeah.
right, during last year, there was a pretty massive move lower. There was a growth scare here into this kind of second half of 2024. And like you had the 10-year treasury go from like 4.7 down to 3.7. You had 100 basis point move
Wow.
lower in the 10-year treasury. Like, yeah, we've, gotten slightly lower yields over the past like month or so, but like ever so slightly, like 20 basis points, 30
Yeah.
basis points lower. Yeah, like 20 basis points. So even if you measure it from this peak here, we're only 33 basis points lower. So like you're not seeing it in the bond market. This is what you see if the bond market is worried about growth. You see something like that or like this. You're not seeing that in the bond market. And the bond market is pretty smart generally. What do we see? Like if I take kind of the belly of the curve and the short end off, like, and just look at the 10-year and the 30-year, like these are significantly higher than they were when the Fed started to cut rates. The 10-year less so, right? It's more pronounced at the long end. But yeah, like this is the bias is higher nominal GDP, in my opinion. The bias is higher yields, especially at the long end, and it's way worse in the rest of the world. Way, way, way worse. So here we can see like Great Britain, Japan, France, Germany. Maybe there's a crisis that comes out of Europe, a sovereign debt issue, because that is what some of these bond markets are kind of indicating. Because remember, the value of the bond looks like that, is inverse to the yield. So, if you thought TLT looks bad, their long bond ETFs are going to look even worse. Maybe it comes out of there. I have been doing a lot of like videos on Great Britain and France, and their fiscal issues and their debt issues. There's certainly, I would argue, Great Britain and France are kind of already in a debt crisis. They just haven't really realized it yet. Some of them. So yeah, like maybe you get something there that then there's contagion, right? But like at that point, when you start talking about black swans, like I kind of generally heavily discount the type of people that are always betting on a black swan. There are some people out there, and I won't name names, but there's a lot on FinTwit that like their base case is a black swan of some sort, whether it's Japan blowing up and the carry trade unwind, or this black swan of massive deflation. Like their base case is deflation. Their base case is a black swan. Well, kind of by definition, black swans are not all the time, and they're very hard to spot. So like, the general trend in markets is higher. Like if we pull up, the SPX, like it is rare to see a black swan. 90 something percent of the time, it's moving in a parabola, right? Like it's parabolic.
Wow. Jeez.
That's the trend.
Because it's designed to beat the dollar. I mean, are you looking at stocks or the S&P against the dollar?
Yeah, S&P priced in dollars. Yeah, the S&P on average returns about 8% a year. And that's about the growth of M2. Like we can pull up US M2, which is the broad money supply, and then you could put a rate of change on there. And yeah, like on average, M2 is growing at about let's do 12. So this is the annual rate of change for the M2 money supply. Take RSI off of there. And right now we're running with M2. This is another reason I'm kind of leaning bullish, is because M2 is running at 5% annual growth rate, and you have ISM new orders. You have all these kind of business cycle indicators, leading indicators indicating a reacceleration in various different ISM surveys, whether that's manufacturing or services. And you have M2 growth running at basically 4.5%, 5%. You have real estate loan growth running still at 2% growth every single year. And yeah, like the average of M2 growth here, we could do this. We'll add a moving average on here and get like the average growth rate here. Let's do like 1,000. Oh, that might have been too long.
No worries.
Let's try 800. That would be 800 months. Should work. It's not working. On average, though, M2 grows at about, I was hoping I could show it. On average, it grows at about 8%. Yeah, there you go.
There it is.
So it's not perfect moving average going all the way back to 1959, but generally speaking, since 1959, the M2 money supply, or the broad money supply, grows at about 7%. Post 2008, it's actually been 8%. So yeah, like the point there is, if the S&P is returning on average about 8% annual growth or annual capital appreciation, not counting dividends, then you're break even on your money, because the money supply is growing.
Wow.
Again, post 2008, it's about 8%. But since 1959, it's about 7%. So, yeah, stocks are not really the best way to actually make wealth, unfortunately. But we know Bitcoin's CAGR is well above 7%, 8%. So
do you think that, still got a few minutes here. Do you think that will continue? Like, I've seen Michael Saylor come out and say, I mean, his whole strategy is based on the fact that the CAGR will not decrease. He's like, we will be minimum 20%, I think is what he said, or 30% even. And he's like, that's what I expect. He goes, it shouldn't get lower. And I was like, well, if that's the case, yeah, you guys will outrun anything you've got to pay off. But if you don't, you are absolutely done for. I mean, in my head, I mean, that's like a great thesis, but if it doesn't play out, that's gonna be really nerve-wracking. What are your thoughts on that?
yeah, I think it's likely that we're kind of done with the like crazy parabolic upside moves. Could they happen? For sure. I think like my base case is that we see kind of what we've been seeing with Bitcoin, which is just like gradual accumulation, like uptrend.
Yeah. More fun than the
so-
stocks, but still kind of a slow grind.
yeah, I think that with TradFi adoption, this is one of the downsides of TradFi adoption. I need to get all my indicators off this. Yeah, I think that these types of moves, like the 2017 bull market, were just ripped. I remember this.
Yeah.
We're just like ripped faces. Like, I think that kind of move is done. You can see, by the way, like when ETFs came about, like you can see the price action just change. This is a log chart. Like it's just like a boring, it's just like a boring uptrend. The ETF was here.
Now there is that similar-ish looking period at the beginning of that before we go nuclear in 2017. So I could see the bull saying, "Hey, well, what about the part where it goes parabolic after?"
Yeah, you could argue this was kind of tame. Yeah. I don't know. I see like a huge kind of like core shift since because I'm pretty sure the cycle indicator type people, like their cycle thing would tell us that we should be seeing this parabolic sort of move by now, like banana zone or whatever, right? And we're not
like the
seeing
power
that.
law. You mean like people like the power law?
Yeah, like, or the 4-year cycle people. Like,
Yeah.
I'm pretty sure that from when they say the cycle started, by that theory, you should be seeing kind of a much stronger move. Now, look, it could happen in a way, right, where say the long end of all the bond markets, right, which is kind of what's happening. The 30-year yield all across the world just starts shooting to the moon. And all these countries in the West are in debt crises. They have to, all of them have to basically implement yield curve control, print $10 trillion. Yeah, like you could get this sort of, right? Like if we go truly kind of a Venezuela sort of full blown emerging market, like you could get this, right? Like if the government just goes crazy with the money printing, whatever the crisis is, you could see it. I think that kind of like the base case should be more of this kind of steady, gradual uptrend accumulation type boring. Yeah, you'll get like a 2-week candle like this one here in early 2024. That Bitcoin moved 33% in 2 weeks. This one, it moved 30%. Like for us, that's not the 2017 sort of price, right? But like if you were to tell someone in the TradFi world, like the normal equity world, certainly the bond world, like, yeah, it's just we're upset because we only had like this 30% 2 week performance, they would look
Mhm.
at you like you're crazy. That's like
Exactly.
3-4 years of
I
price
know.
action in 2 weeks. So we still are getting like good solid moves. It's just the problem is everyone got used to kind of the old
The
world.
Nexus.
Yeah, where you had like 80% pullbacks and these
Interesting.
massive rippers. Like people got used to that, right? All the kind of old, either the old people, that have been in Bitcoin a long time, been in crypto a long time, they got used to that for sure. And then a lot of the new people are coming into Bitcoin or coming into other cryptos, like hoping that
Yeah.
it's still I think, this might be unpopular. I might get canceled for saying this, but like
Oh boy.
if you're looking for like this sort of thing, like go play around with like the other S coins, right? Like that's where
Wow.
you're gonna get crazy, in my opinion, because they're so small and they're so speculative and they're so liquidity sensitive and like tiny market cap compared to Bitcoin now. There's no derivatives on top of them. Well, there's perps, but no options chains, no structured products, nothing like that, like we have on Bitcoin. So if you are like going for this, like I don't think that's the move. I don't think trying to catch one of these, crazy parabolic moves is like, I think that you see that the trend for a decade has just been up. And
Mm,
yeah, like, is the CAGR diminishing? Probably. Like, are we gonna probably see these like 100% candles in a single month? Probably not. Now, if they print a bunch of money, right, and kind of really get the money
sure.
printers going, you could. But like, my base case is kind of just more of this, which is like not bad, right? Like, if
Hmm.
even if we return 30-40%, like I'm
It's huge.
okay.
I will take
Yeah,
that.
it's
I will
massive.
definitely take that.
Versus all of the risk in the equity market, right? Because like,
Yeah.
what's your alternative? Your alternative is the S&P 500 at record high valuations.
Yeah. And it's the asset you're holding. It's the fundamental asset you get to hold.
And yeah, and with Bitcoin, you can take it, you can memorize 12 words, take it across a border. They can confiscate your SPY, they can confiscate your QQQ, they can't
Yep.
confiscate your Bitcoin, right? So like there's all these other properties to it that like once you
Yeah.
start like really going down the list, it just makes way more sense in my opinion.
Yeah. It's crazy too because I oftentimes will find any possible. I want to find a reason to bring to you or dark side that Bitcoin could fall apart. So I go on TikTok and I find videos where people who are really smart will say, "Hey, have you thought about this?" And every time I take it back to the drawing board, I put it through ChatGPT, I ask an expert. At the end of it, it's still the pros outweigh the cons by so much. Because you're like, yeah, could Bitcoin fall apart and get hacked by some genie? Then yeah, well, sure. But like you're comparing, you're talking about what you said, which is like you're waiting for a black swan. But in the meantime, you got to choose where you're going to put your money. You got gold,
Yeah,
you got Bitcoin, you got S&P. You don't have that many choices. Like you pick one
yeah,
and kind of roll with it. But you
and
got to
just
decide.
hedge. Like if you're
Yeah, there you
really
go. You could do
that
that too.
anxious, if you're that worried, or if you really think a pullback is coming, go buy. Joe
Fair.
Carlasari said this recently.
Yes, he did.
Go buy the out of the money puts that expire in like 2 years on IBIT. You'll
Yep.
make a ton of money if you're so convicted that it's gonna drop 70%. Go buy the whatever 40
Yeah.
strike IBIT puts that expire in 2 years. Like you can always hedge, and that's one of the volatility is kind of compressing, but one of the pros is that you can now hedge your exposure with things like puts, writing covered calls, right? Like
Hmm.
selling cash secured puts, all these various kind of more complex mechanisms for than just buy Bitcoin, sell Bitcoin, buy Bitcoin, sell
Mm,
Bitcoin. Now you have options which allow you to express a view over not just price, not just two dimensions, but then over time, which is that
mm.
third dimension. So
I love that. All right, here's my final question here. So we've had John Space so many times, but just because we have you on the stream, for the MSTR thing, Darkside went on a whole tirade for a couple months there about how there's a negative feedback loop created for shareholders, And I get his point. He's like, look, you are the biggest Bitcoin treasury. You matter. Like your decisions make an impact. And so I think he's just concerned about that and wanted to make sure that people saw it and heard the opinion out there about. He was like, hey, if we get over a certain MNAV, sell the Bitcoin, use that to pay off. And if it goes up, you buy Bitcoin kind of thing. And I was like, that sounds reasonable. It just feels impossible with Saylor's message for the last few years. But I kind of want to get some of your thoughts on that on video, and just to see if there's been any updated thoughts as well.
Yeah. It's hard. I'm looking for the MNAV. I think it's under balance sheet.
Oh yeah.
I know it's come in a lot.
There it is.
MNAV.
His take is so reasonable. It sounds so reasonable, but there's so much discrepancy on both sides. I was just curious in your thoughts.
Yeah. I would probably like sell if I was long the shares. I would probably like sell. I don't know why it's not showing here. I have it right there.
You're right.
But yeah, I would probably like sell calls if IV goes crazy. Like if you get another move like this, and IV just goes to the moon, like sell calls. This is what I would do. When you sell calls, you're capping your upside. But like, that's probably how I would handle it. If the MNAV does get to be, I was kind of hoping to see, I haven't actually checked it in a while. I've been saying like, if the MNAV gets to like 0.8 and the MSTR bulls are like on, like super depressed and like talking about just, panic selling and just, I'm done with this. Like that sort of capitulatory moment, I would actually probably buy MSTR. I don't know what the MNAV, I know it's dropped a lot, but I would kind of want to see like that capitulatory price action. I pointed this day out here, this period of time. I said that looked like a bottom, like that sort of thing. If the MNAV drops, like MSTR is worth something over 1 MNAV. I don't know that it's worth 4 times net asset value, but it's certainly worth more than 1 net, 1x premium. So if it drops below 1, I haven't checked. I was hoping I could see, but yeah, if it drops below 1, like I would, and you not only had that, but you had like capitulatory kind of price action, I would probably go long, because the direction is definitely not an expansion of MNAV. I know that much. Over the past year or so, it's been a compression of MNAV. So yeah, like could we see like a further compression and then that kind of capitulatory price action? In my opinion, I would probably want to go long there. But then, on the other side, like when it's like 3.5, 4 times net asset value, like in my opinion, that's when you like sell calls. If you really like the stock, hold the stock and sell calls when IV is paying you to do so, which is what it was doing back here when I told people to do that. IV was like 500 for a 30-day at the money call. That is paying you to sell volatility. That is, and you have to, you know it when you see it, but that's kind of how I think about MSTR is like generally if MNAV is compressing over the past year, like wait for that, if you're not in it like me, I would wait to see that kind of capitulatory sort of price action. And for MNAV to go to like 0.8, probably maybe 0.7, something like that. In my opinion, you go long there and then you hold it as eventually MNAV starts to expand and Bitcoin price has fallen with that, or is going sideways or something. So if Bitcoin starts to rip, then you capture it both directions. I just kind of think it's in kind of a no man's land recently, if I had to say.
Yeah, and I think that's why people are talking about it, because we're on all the assets, but it feels like we're just kind of going sideways. And I think at some point when you're sideways long enough, we just start making things up in our head. We start talking about things and discussing them. And then we get to the point where we've discussed it, but we still have to wait. And we're kind of just like, well, we kind of made our decisions, but now we got to wait for 11 months to see this plays out.
I mean, I'll point out this though. Like if you go to the monthly chart, I always say this, but like this is crazy. Like we're okay. Like Joe has been talking about the highest monthly close, right? Like I will also point out as like bullish indicator, the past 2 days have been very, very bullish for Bitcoin. And if you look at like SPY today or NASDAQ, these daily candles look like kind of ugly. Um,
Mm.
so like SPY didn't have the best day, QQQ didn't have the best day, but Bitcoin past 2 days have been quite strong. And if you once you zoom out, look at it on like a monthly chart, this still looks good.
But
Like
those wicks at the top, I mean, those wicks at the
yeah,
top look like
but
we're headed kind of
yeah,
down
maybe
right after.
and maybe you have like a 10, 15, 20% pullback, but I would buy
Yeah,
that. You know,
that's
maybe
true.
we
That's
come
true.
back down to test 90 or 100 or something like that. That's totally
Dude,
possible.
the FUD will be insane for MSTR when Bitcoin's down. I mean, I haven't
Yeah.
seen MSTR in a moment where Bitcoin is just down, but
That's
I
what I'm waiting
imagine it
for.
is toxic.
That's what I'm waiting for, that irresponsibly long MSTR group to go on like suicide watch, to be
Yeah,
like
they're like,
admitted
someone
into the
take
cycle.
the keys. I don't want to run this
Yeah.
group anymore. And Infra's like,
Yeah.
let's start buying, baby.
That's when you buy, you know.
Exactly. And that's the best part about the live shows for me, because like you can create content all day long. But the problem is if you're creating, or especially if you're an audience and you're just kind of watching people create content, but you're not participating via like the spaces where you're kind of involved. Like at least in my head, if you're in a space and you're listening or you're on stage, I feel like it's all participatory a lot more than a stream is. I feel like streams we're speaking to each other, to the audience, versus with spaces like we're speaking, I guess it's still to the audience. It just feels different. But I have noticed with the spaces, because we're meeting so often, multiple times a week, the traders every day, I have so much of a more like down to earth pulse on what's going on day to day, where we've been multiple times been able to pick up like really solid dips because you didn't have 2-3 days to sit and wonder if you should pick it up. We just were happy to cover it every day. Hey, this is good. Yesterday we had this happen. Now we're touching this. We're still in this range. And like that's been really, really helpful for me for the past few months or the past year or so. But I mean, this probably the number one thing I'm paying attention to, because I'm only interested in MSTR. I'm interested in XXI whenever that comes out, the merger with Tether and Cantor Fitzgerald. So once that comes out, that's the two stocks I'll be paying attention to. Maybe a couple more, but those are really like the two main ones that I want to follow. And so that's kind of where my head's going to be at. And I don't really care where the price is at. I'm not really interested in the stocks unless we go all the way down. Then I can get in at decent prices. Otherwise, I'll probably just buy Bitcoin.
Yeah, I mean, yeah, the RSI is also just kind of indicating like consolidate. I think Bitcoin looks great. Like, yeah, there's always risks, but like the way I look at it is I have like an 8-hour, 12-hour RSI indicator where once it starts, I think I put it at 31.5 or something, so that I would be sure to catch it. Once RSI on like a longer time frame, like the 12-hour, the daily, I think I might have one on the 8-hour. Those are like zoom out and look at every single time that it had one of those dips below 30 on the RSI. It's always a good buying opportunity, every single one of them. So like that's kind of how I look at it, is like it's going to do what it's going to do. It's going to do Bitcoin things. It's going to be volatile. It's going to have little pullbacks, but like I just kind of have these alerts set up where when the RSI on like longer time frames, when it dips below 30, I just buy and then I wait. And then it happens again and I buy again. And
Yep.
that's kind of, I think, the best way to handle it. Cause yeah,
That's
like
genius.
on an
Honestly, that's smart.
like if you look at like the 5 minute, you will like lose your mind,
Yeah.
like
And
trying
if
to
you don't want
trade
to
this.
trade and spend all your time trading, maybe you have a higher income skill or you have a job and you're like, look, I could trade and there's ROI. I can make money. He goes, but maybe there's a better use of money. If you can spend a shorter amount of time trading, still finding ways to multiply and
Yeah.
leverage your money, that's the best of both worlds, in my
Yeah.
opinion.
Cause buying dips and holding an asset long term, people talk about compounding your wealth. Well,
Yeah.
the way you compound, if you never sell, the way you compound is by buying dips, by adding on dips. So that has the same effect over time, which is it compounds your wealth. It's not, you know, I made 10% day trading today and I'm going
Right.
to make 10% tomorrow. Like it's not that sort of, it's the same general concept. It's just done a different way, I guess.
Yeah, 100%. And yeah, respect to all the traders out there. I mean, I've
Oh
tried to
yeah.
fight. I've tried to fight for their like. I'm like, guys, listen. I don't know why you guys crap on them. I'm like, they're spending 8 hours a day, 10 hours a day, just like you at work. They just happen to be in front of a computer trading stuff. So why are
Look,
you so mad?
I used to day trade this thing,
Oh,
zero
this year.
day SPY
Oh,
and
okay.
sometimes NASDAQ. Like yeah, I used to day trade options on SPY and QQQ
Wow.
and stuff. So I know that life well. There's nothing wrong with it. I just hated losing money so much. It was pretty rare. Like my win rate was pretty good. I would just do 1-to-1 risk reward and then had
Mm,
like an 80% win rate. But
nice.
like 20% of the time I would be losing money. And I just hated that. And it eventually got to a point where I was like, yeah, I guess I'm okay at this trading thing, but like the stress
I
is
see.
just
Yeah.
not worth it, you know?
I mean, if you're it depends. Like there are people who are making insane amount of money.
And
I
they're
bet
made
that
for it. Their
eh,
mentality is
they are made
made
for
for
it.
it.
I'd
Yeah.
also bet 9 out of 10 of them and just have communities they're making real money from, and they're still trading. And I'm sure some people are making great money trading, but it probably is true that most are making the bulk of their money trading unless they have access to great liquidity or some kind of prop firm where they only need to make 2 or 3%.
I did the prop
And
firm thing too.
It
I
it
traded
just it sounds
futures
so nice.
with
It
the
sounds
prop
so
firm.
easy. It's really hard. Like people think trading
Yeah.
is easy. It takes you a considerable amount of time. I spent 2 years in the bear market learning it, and I didn't even get good. You have to really lock in. You have to practice. You have to journal. You have to take trades. You have to do all of it. If you skip any of it, you're not going to be that good. And if you're not that good at trading, it's almost not worth it. Like the time and stress, like you're saying, it's a lot.
Yeah, this is when I day traded, this is what it looked like. So
Hmm.
the people that are telling you, oh, you need like 18,000 moving average crosses and you need VWAP and you need VRVP and you need this, it's like it does not have to be that complicated. I literally would just trade like a bear price action chart like this.
Yeah.
So this is all you need to, again, my win rate was about between 75 and 80%. Like that's all you need to have a 70. Learn what this is telling you, right?
Hmm.
And of course you watch, right? I would always watch my what's going on with bonds. I'd watch what was going on with I don't know where it is. Yeah. I'd watch, gold, oil, sometimes dollar, and of course various points on the yield curve, VIX. Because VIX can send you signals too sometimes. Like
Yeah.
sometimes like we saw that period of time where VIX was moving higher as SPY was moving higher. It was like, oh, but yeah, like something like this and then just like a bear chart, that's like really all you need in my opinion. So it doesn't need to be more complicated if you're trying to trade and you're like it feels overwhelming and it's just so much and it doesn't have to be so much. It can just be this, like it could
Yeah.
just be literally just the price action is enough. Once you learn what it's telling you, once you learn how to really interpret a candle, that's all you need. So
Yeah. I
simpler
agree.
is better. I started off with like 20 different indicators. I had MACD, I had RSI, I had VWAP, I had all these moving averages. My chart looked like spaghetti, like I couldn't even see the price action behind all the indicators. And then gradually, like over time, I would like remove one every month. And I found that I was like getting better, from like when I started to gradually getting better. And the better I got, the more like indicators I could remove. So that was just
Wow. Love
that
that.
was just my experience. Maybe it's different for other people, but
Yeah, I mean, I know plenty of people who have charts that look like absolute hieroglyphics everywhere.
yeah,
I'm just like, I don't know what's going on
crazy.
there, but if it works for you and you're making money, I guess I can't hate on it.
Yeah,
But
yeah, yeah. Whatever works for people.
I
I
agree.
think there's a bias towards like too complex though. So I always try to.
Probably
Yeah,
it looks sexier if you have complex numbers and charts, and because it makes you look like you got something they don't, and then you can charge for your
yeah,
course. I think that's why
that's
most people do
true.
it. But I know excellent traders who don't have 10,000 a month Discord where that's the bulk of their money, and they really are trading. It's just hard. So for anyone who wants to trade, I highly recommend it. I just know that it's a solid skill set, but it's freaking hard, just like anything
Yeah,
else.
it's
And
emotionally hard.
yeah,
Yeah.
but and here's why the reason I wanted to say it, because, and I'll share screen real quick, because and I wanted to show Robert's YouTube channel, because if you like this conversation, like there is so much more. It's ridiculous, because you can just
Not
go to his
trading,
YouTube channel,
no
not
trading
trading,
discussions,
but
but
macro, looking at
yeah.
charts, pulling things apart, going under the hood, why things are happening. And you can see the titles right here. You can see what the topics are, but I mean, you can see that people are gravitating towards this content. That for some reason, people want to know what's happening under the hood nowadays. I mean, 25,000 people in a few months is crazy. So there's a lot more of this. And the reason I said to learn trading is because once you get good at skill set, whether it's trading, investing, or whatever it is, you now have the expertise to go and make a YouTube channel. And like a
Yeah.
whole new world is now opened up for Robert, going from X, chilling on X, to just pumping on X, and then now to YouTube. It is the coolest progression. So I just wanted to shout you out and say if you have any things you want to say about the YouTube channel or the journey as well before we wrap. Definitely, yeah.
Yeah, it's like I didn't really know. I was really interested in markets. I was really interested in macro, and I just like devoted my entire life to it. I spent like 12, 13, 14 hours a day learning at whether it was TradingView, Fred, reading academic papers, everything. I was just trying to absorb everything. And then kind of somewhere in there, I was like, well, I can try trading. And I did. And I actually got pretty good at it, but like the stress was too much. And so then I was like, well, what do I do if I'm not going to trade? And I had all this knowledge after, I don't know, 5 years of spending so much time that I was like, well, I think I understand this macro thing pretty well. Like, and I just did it, So if
So
you
cool.
devote enough time and energy to something, eventually there is some way to make it work for you.
And you're doing shorts, I saw.
I
Like,
did
okay.
in the very, very beginning. I did.
Oh,
Yeah.
okay.
I didn't know what I was doing. I was like, I'm
Yeah.
just going to start a YouTube and like figure it
Very
out.
cool.
So yeah, like you also don't need to have a plan. You don't need to have a 28-page business plan. Like just go for it. Like,
Agreed.
yeah, because that was like 5 months ago and it's at like almost 25,000 followers. So
the internet is insane. Like the
just do
possibilities
it.
if you do
Yeah.
things are
Just
crazy.
you can just do things. Like you can
Exactly.
just do things. Yeah.
What's his name? Jack Mallett said that. He said, I'm going to be CEO of 2 different companies. He goes, I mean, I have no idea if it's going to work. It might be a disaster, but he said the same thing. He's like, look, you can keep yelling at me for heading 2 companies. He goes, but also I know I can do things.
Yeah.
And we'll see what happens. And by the way, if you guys want to follow him on X, if you're watching on YouTube, description, if you're on X, just you can click his handle right above and it'll take you here. But yeah, man, he's the same kind of thing, right? Built a great following, talking about the exact things we talked about today. Highly recommend you guys give him a follow. If you're going to like this kind of content, you're going to like it a lot more on X because it's a little bit easier and faster to digest even. So, if you're just looking for quick stuff on the timeline, that's not just meme coins and like influencers pretending like they didn't get paid already kind of thing to show you their meme coin, then I think these are the type of people you want to add. So definitely give him a follow. And dude, Robert, appreciate you coming on, man, as always. And trying to do more of these. I feel like your voice is one that should be amplified and it needs to be. And there's just, look, there's all sorts of grifters out there in the industry. The way we're doing it at Wolf, I just feel like we're able to win in spite of those guys doing their thing, and they can keep grifting, they keep doing their thing. But I'm like, look, at some point, people gravitate towards authenticity. They gravitate towards all this stuff. So like, we still win anyway. So it's like, we'll just eat it. We'll do the thing. So I just want to say,
the free market of ideas. Yeah,
exactly. That is exactly it. Robert, is there anything you have coming up on the YouTube channel or like live streams, podcasts, anything that's coming up?
Nothing. I don't think so. Nothing major. Just I try to put out a video every day though. So
hell yeah. Legend. Right on, man. Well, best luck with that. And for everyone who's watching back at home, if you haven't already, please do give them a follow. Retweet or repost the stream if you haven't already. If you're on X, repost the stream. It does help us out a ton in getting the word out there. It is the coolest feature still for me for X is the retweet. It's absurd access. One retweet can take you from a nobody to working with Elon Musk. It's the craziest thing. So yeah, man. Anyways, have an amazing day, everybody. We'll catch you guys all in the next one. Take care. 3